Okay, picture this. It's a Tuesday morning. You've just gotten off the phone with your college roommate, the one who always seems to be on the cutting edge of everything.
Hmm.
He's breathless. He tells you he has found the, quote, golden ticket. Literally, he says gold bullion is bottoming out, the geopolitical situation is a mess, and gold is the only safe haven. He says, quote, it can only go up from here.
Oh, that phrase, it can only go up. If I had $1 for every time that phrase preceded, like a total financial disaster, I'd be retired on a private island by now.
Exactly. So you catch the bug, the FOMO, the fear of missing out, it kicks in. You walk into your bank or your investment firm and maybe you're sweating a little bit, buzzing with that adrenaline.
You're all hyped up.
You sit down across from your advisor, let's call him Peter, and you say, Peter, I need a loan. I want to borrow $50,000 and I want to put every single cent of it into gold bars right now.
It's such a high-stakes moment. You're emotional, you're absolutely convinced, and you're basically asking to leverage yourself to the hilt.
So here is the question that kicks off our deep dive today. Does Peter, the advisor, just smile, slide a contract across the desk and say, you got it, boss, sign here?
Yeah, does he take the order?
Or does he have a regulatory obligation to look you in the eye and say, no, I can't let you do that?
It's a fascinating dilemma because it really cuts against our intuition about how businesses work, right?
Totally.
Usually if you walk into a store and want to buy something, the store sells it to you. If you go to a car dealership with good credit and you ask for a Ferrari, they don't ask if you're a good driver. They just give you the keys.
Right.
But in financial services, specifically under the regulations we're looking at today, the advisor isn't just a salesperson.
Yeah.
They're more like a structural engineer.
Or an architect.
And an architect, I like that. Right. You can ask an architect to build a penthouse with a swimming pool on the roof. I mean, that's your dream.
Mm.
But if they look at the foundation of your house, your actual financial reality, and they see it's made of sand, they have a professional and a legal duty to say, the structure cannot support that weight.
That is the perfect setup for today. We are calling this deep dive the architect of wealth. We're going to decode the responsibilities of a dealing representative. And look, I know the job title, dealing representative, it sounds drier than toast.
It does not sound exciting.
No, it sounds like somebody who just, stamps forms all day. But as we went through this stack of sources, I realized this role is actually the gatekeeper. They are the person standing between you and potential financial ruin.
It really is that serious. It's not just about picking winning stocks, which is what I think everyone assumes. If you look at the materials we have, the regulatory guidelines on leverage, the massive Know Your Client or KYC protocols, the rules for protecting vulnerable seniors, and even the macroeconomic data, it becomes so clear that this is about a rigorous framework. It's all about one word: suitability.
Suitability. That is the magic word today. We're going to explore why good advice isn't just a feeling or some kind of hunch. It's actually a documented 6-step process. We're going to look at the, frankly, terrifying math of leverage borrowing to invest, and we have some brutal case studies about what happens when that goes wrong.
And then we're going to pivot in the second half to the invisible machinery running in the background, the economy itself.
Weather.
The weather, exactly. Inflation, GDP, supply and demand. Because going back to your architect analogy, you can't build a house without understanding the climate it's going to exist in.
I love that. And what really struck me most about this stack of sources is that it kind of flips the script on how we think about investing. We usually obsess over market performance.
All the time.
Did the S&P 500 go up? Did that tech stock crash? But these sources suggest that for the individual investor, the real safety net isn't the market. It's the regulations. It's the boring stuff, the forms, the checklists, the balances that actually saves you when the market goes haywire.
Precisely. The market is going to do what the market does. You can't control it, but you can control the suitability of the strategy you're using to navigate it. The architecture has to be sound.
So let's get right into that foundation. Let's go back to that guy in the advisor's office. Me, I guess, wanting to borrow money for gold. How does an advisor actually decide if they can sell that to me? Because I'm an adult. I'm asking for it. Why can't I just do what I want with my own, borrowed money?
Because of two acronyms that basically govern the entire industry, KYC and KYP. Know your client and know your product.
Okay, we've all heard of KYC. Usually feels like that moment where you have to show your driver's license to open a bank account, just proving you are who you say you are. But the source material here suggests it's a lot deeper than that.
Oh, it's much, much deeper. It's an invasive process, and it has to be. It's an objective analysis of your entire financial life. The source lists it's a laundry list of criteria that must be collected before the advisor can even whisper a recommendation.
Let's run through that list because I really think people underestimate how much info they need to give up and why.
Well, you start with the basics: employment status and occupation. But think about why they ask that. It's not just for small talk.
Right.
They need to know about stability. Are you a tenured professor with a guaranteed salary for the next 30 years, or are you a freelance graphic designer whose income fluctuates wildly from month to month? That fundamentally changes your ability to absorb risk.
Okay, that makes sense. Then there's income, obviously. But then they ask for net worth. And the source makes a really specific distinction between financial assets and net fixed assets.
Yeah.
Why does that distinction matter so much?
This is absolutely critical. You might have a net worth of, say, $3 million because you own a massive house in Toronto or Vancouver. That looks incredible on paper.
I feel rich.
You feel rich. But you can't sell your guest bedroom on a Tuesday afternoon to pay for a margin call.
Ah, that's liquidity.
Exactly. A house is a fixed asset. It's illiquid. If you need cash now to cover a bad investment, that beautiful house doesn't help you one bit. So the advisor needs to know your liquid net worth cash, bonds, stocks, things you can turn to money almost instantly.
And then after that, they look at age, investment objectives, time horizon, and your risk profile. And I'm guessing if we were talking about leverage borrowing money to invest, like in our gold example, the scrutiny just goes to a whole new level. The dealer typically has a specific leverage worksheet, right?
A whole other level, yes. They aren't just guessing. They're not going by gut feel. They are calculating your TDSR, your total debt service ratio. They're looking at what percentage of your liquid net worth this loan would represent. It's all about math.
Okay, let's deep dive into leverage specifically, because this seems to be the area where regular people get into the most trouble. The definition is simple enough: using borrowed funds to increase your potential return. It's the whole concept of OPM, other people's money. Rich people do it all the time with real estate.
Yeah.
Why is it so much more dangerous in the stock market?
I think it's because the risks are, they're asymmetrical. And honestly, our brains aren't always wired to understand the math of leverage intuitively. We see the upside so clearly. If I have double the money, I make double the profit. But we sort of gloss over the devastating downside.
The source mentions magnified losses. I want to pause here and actually walk through the math on this, because magnified losses just sounds like a buzzword until you see the red ink on your statement. Can you break down the mechanics of, say, a 2-to-1 leverage scenario?
Sure, let's make it really concrete. Let's say you have $100,000 of your own hard-earned cash. You invest it in a standard portfolio. You have a bad year, and the market drops 10%.
Okay, so my $100,000 is now worth $90,000. I've lost $10,000. It hurts, but I'm still alive. I can probably recover from that over time.
Right. It's a standard bad day at the office. You're down, but you're not out. Now let's add leverage. You have your $100,000 and you decide to borrow another $100,000 from the bank to double down. So you invest $200,000 total. You are now controlling double the asset.
And I'm feeling pretty good about myself. If this goes up 10%, I make $20,000 instead of $10,000. I'm a genius.
You feel like a genius, but the market drops that same 10%. On a $200,000 portfolio, a 10% drop is a $20,000 loss.
Okay, so the portfolio value goes from $200,000 down to $180,000. That's simple enough.
Correct. But here is the kicker. And this is the part people forget. Remember, $100,000 of that money isn't yours.
Right.
That belongs to the bank. The bank does not share in your losses. They want their full $100,000 back, period. So when you calculate your equity, your slice of the pie, you have to subtract the bank's loan from the remaining value.
So you take the $180,000 remaining value,
Yeah.
you subtract the $100,000 loan,
Yeah.
and that leaves me with only $80,000.
Exactly. The market went down 10%, but your personal wealth went down 20%. You lost $20,000 of your own money, not 10. The loss was doubled.
And that's just a 10% drop. What if the market has a real crash, say 50%, like in 2008?
Let's run those numbers. It gets ugly fast. Your portfolio starts at $200,000. It drops 50%. It's now worth $100,000.
Okay.
The bank takes their $100,000 loan back. You are left with zero.
Yeah.
You have been completely wiped out. A 50% market drop resulted in a 100% loss of your personal capital.
And in that catastrophic scenario, I'm assuming I still owe interest on the loan during that time.
Oh, absolutely. That's the other risk the source highlights that just adds insult to injury, the interest costs. If your investments are returning, say, 4%, but your loan interest is 6%, you are actively losing money every single day, even if the market is going up slightly. You're just bleeding cash.
There's a specific rule in the source material that is just burned into my brain. Don't bold. The client is responsible for repaying the loan regardless of the investment outcome.
That is the rule that destroys people. The bank doesn't care if your sure thing gold stock went to zero.
Yeah.
They don't care if you lost your job. They want their principal and they want their interest. If your investment hits zero, you still owe the full $100,000 loan. You now have a massive debt and no asset to pay it off with.
Which brings us to a specific case study in the text. Joe. Joe is basically the guy I was channeling in the intro. Let's look at his situation. The source says Joe wants to borrow funds to invest in precious metals, and his reasoning is literally that he heard from friends that metals have fallen in value, and the only way for them to go now is up.
The famous last words of so many investors, the only way is up. It's the gambler's fallacy, right? Just because something has dropped doesn't mean it's due to bounce back. It could just as easily keep dropping or go to zero.
So, in a pure sales culture, the response to Joe would be, great, sign here, let's get this done. But under the regulatory framework of a dealing representative, this is a massive red flag.
Yeah.
The source makes it crystal clear. The advisor must do a suitability assessment.
They absolutely have to. They have to run those numbers we talked about. Income, net worth, risk tolerance. But here is the nuance that I think is so important, and it answers your earlier question about why you can't just do what you want. Let's say the advisor tells Joe, hey, this is really risky. The math says you shouldn't do this. And Joe says, I don't care. I'm a cowboy. I'll sign a waiver. Just let me do the trade.
Yeah, that's the I'm an adult and I accept the risks argument.
Yeah.
Can the advisor proceed then if I sign on the dotted line?
The source is explicit on this, and it's a powerful sentence. It says, disclosure does not negate your obligation to assess whether leverage is suitable. You cannot just disclose your way out of bad advice. Even if Joe signs a waiver that's 10 pages long, if the advisor's objective analysis shows that leverage is unsuitable for him, maybe he doesn't have the cash flow to service the debt, or his time horizon is way too short, the advisor essentially has to save Joe from himself. They cannot facilitate the trade.
That is a huge responsibility. It really positions the advisor as a guardian or that architect rather than just a facilitator.
Yeah.
But let's look at the flip side of this. What happens when the advisor is the one pushing the risk? We have the case of Catherine and Peter in the source documents.
This one is just heartbreaking, and unfortunately it feels quite realistic. Catherine is an elderly widow. She's in her 80s. Her profile is crystal clear. She needs regular income to live on. She has a very low-risk profile, and naturally, at 80 years old, she has a short time horizon.
Right. And then enters Peter Sly. I mean, the source naming him Sly is a little on the nose, isn't it?
Subtle as a brick, yeah. So Peter Sly is her dealing representative. He recommends she use a leverage strategy borrowing money to boost her income because her funds are, depleting. He suggests she invest in aggressive global funds because they had a good 3 months.
My blood pressure is rising just reading that. It feels predatory.
It is a textbook breach of the rules. The source states clearly, Peter breached MFDA Rule 2.2.6. He recommended a strategy without doing a proper suitability assessment. But the thing is, even if he had done the assessment, the verdict is right there in the source. Based on her age, investment needs, risk profile, and time horizon, it is very likely that leverage is not suitable for Catherine.
I want to play devil's advocate for just a second on this senior definition, though. The regulations flag anyone over 65 as a senior.
Yeah.
But, I know 70-year-olds who run marathons and day trade crypto and are sharp as a tack.
Yeah.
Isn't it a bit paternalistic to just say, sorry, you're 80, you can't handle leverage?
That's a fair pushback. And you're right, competence doesn't vanish the day you blow out 65 candles. We all know seniors who are sharper than a lot of 30-year-olds. But the regulation regarding leverage in seniors isn't just about cognitive intelligence, it's about recovery time.
You mean they don't have enough time left to make the money back if something goes wrong?
Exactly. It's the simple, brutal math of their life. If a 30-year-old gets wiped out by a bad leverage bet, they have 35 working years to rebuild that wealth. It's incredibly painful, but it's not fatal to their entire life plan.
Okay.
If an 80-year-old widow like Catherine gets wiped out, she has 0 working years to recover. She might be unable to pay for care or housing. The consequences are catastrophic and irreversible. That is why the suitability bar gets so much higher. It's not that they aren't smart enough, it's that they don't have the luxury of time.
That makes perfect sense. The risk isn't just the probability of the loss, it's the impact of the loss. That's a great distinction. Also, the source drops a very specific rule regarding leverage that I think is worth noting. Leverage should never be used solely as a tax reduction strategy.
That's another classic trap. People get told they can borrow money to invest and then write off the interest payments on their taxes.
Right.
They get so focused on sticking it to the tax man that they totally ignore the underlying investment risk. But if the investment fails, that tax write-off is a very, very expensive consolation prize. You saved, what, $3,000 in taxes, but you lost $50,000 in principal? It's just bad math.
So we've established that the advisor has to play defense. They have
Yeah.
to stop the Joes from gambling, and they have to stop the Peters from being predatory. But how do they actually build a plan that works? This moves us into the blueprint section of our deep dive. Strategic investment planning, or SIP.
Right. And the source makes a really important distinction here. The KYC and suitability rules we've been talking about are regulations. You have to follow them or you could lose your license. The SIP process is described more as a best practice. It's the methodology for actually helping a client achieve their goals in a structured way.
It's a 6-step process. Step 1 is the engagement. Sounds like a marriage proposal.
In a way it is. It's a commitment. It starts with the letter of engagement. It sounds bureaucratic and boring, but it's actually a vital protective document for both the advisor and the client. It defines duties, fees, and most importantly, the level of service.
Why is that so important to spell out?
Because the #1 cause of lawsuits and complaints in this industry is unmet expectations. If a client thinks, my advisor is watching my portfolio every minute of every day and will sell the second the market turns, but the advisor's actual service model is we review the portfolio once a year, you have a massive gap.
A recipe for disaster.
A total recipe for disaster. When the market crashes and the advisor hasn't called, the client feels betrayed and sues. The engagement letter puts it all in writing. Here's what I will do. Here's what I won't do. It manages expectations from day one.
Okay, that makes sense. Steps 2 and 3 are about data and status. We talked about gathering data, but I like the phrase the source uses. Clarify status, problems, and opportunities. It mentions a reality check.
This is the hard conversation. This is where the architect tells you the foundation is sand. The source says explicitly, if the client's resources are not adequate to meet his or her financial objectives, you must work with him or her to refine the established priorities.
That is the most polite corporate speak I've ever heard for telling a client they're dreaming.
That's exactly what it is. It's the advisor sitting down and saying, okay, you have saved $50,000. You've told me you want to retire in 5 years with a yacht. The math does not work. So we have to change the variables. You either need to work until you're 75, you need to start saving half your income starting today, or we need to talk about buying a rowboat instead of a yacht.
That's the architect part again. You can't build a castle with a shack's budget. Now, step 4 is the plan, and I want to highlight the warning the source gives about illustrations and projections.
Oh, absolutely. This is the big fat disclaimer section. When an advisor shows you a chart that says, in 20 years, based on these projections, you'll have $1 million, that is based on a whole bunch of assumptions.
Right.
We assume inflation will be X, we assume returns will be Y, but the source warns that all plans must state very clearly that these results are not guaranteed. And the math is incredibly sensitive to small changes.
How sensitive are we talking?
Well, think about the rule of 72. It's a simple way to see it. If you get a 6% return, your money doubles in 12 years. But if you only get a 3% return, it takes 24 years. So a small variance in your assumed return can literally shift your retirement date by a decade or more.
Wow.
The source gives an example. If you assume a 3% return compounded quarterly, but you actually get 2.5%, just a tiny 0.5% difference, the future value of your portfolio drops significantly over 20 or 30 years. It's the tyranny of compounding.
So a plan isn't a crystal ball. It's a best guess. It's a roadmap.
It's a roadmap drawn in pencil, not in permanent ink, which leads directly to steps 5 and 6. Implementation and monitoring. A plan is worthless without commitment. And the source notes that monitoring isn't just watching the stock ticker, it's watching the client.
Because life happens.
Right.
Things change.
Exactly. You get married, you get divorced, you lose your job, you get an inheritance, you have a health crisis. A portfolio that was perfectly suitable for you when you were single and gainfully employed is potentially toxic if you just lost your job and had triplets. The advisor's job is to monitor those personal circumstances just as closely as they monitor the GDP.
Speaking of personal circumstances, let's talk about the most sensitive part of our stack today. Part 3, the human element, protecting the vulnerable. We already met Catherine, the 80-year-old widow, but the regulations go much deeper than just don't sell leverage to grandma.
They do. And this is a huge and growing area of concern for regulators as the population ages. The source defines a senior simply as anyone over 65, but vulnerable clients is a much broader category.
Okay.
It includes anyone with an illness, an impairment, a disability, or, and this is the key phrase, aging process limitations that create a risk of financial exploitation.
Financial exploitation.
Yeah.
That is a chilling phrase. It implies there's a predator involved somewhere.
It does. It refers to someone using undue influence, manipulation, or deception to control a client's assets. Maybe it's a new friend or a romantic partner who suddenly appears out of nowhere. Maybe it's a child pressuring a parent for an early inheritance. The regulators have handed advisors some very specific tools to fight this, and one of the most important is the TCP, the Trusted Contact Person.
Now, wait, I can hear listeners thinking, I already have a power of attorney, a POA. Why do I need a TCP? Isn't that just more paperwork?
The source is very, very specific that these are not the same thing. Correct. And confusing them is incredibly dangerous. A power of attorney is a powerful legal document that gives someone else the authority to act for you, to sign checks, to make trades, to sell your house. It's like giving someone the keys to your car and the title deed.
Total control.
Total control. A trusted contact person, or TCP, has no authority. They cannot make trades. They cannot withdraw money. They can't do anything with your accounts.
So what are they then? If they can't do anything, what's the point of having one?
Think of the TCP as the smoke alarm, or like an emergency contact. If the advisor can't reach the client, or more importantly, if the advisor suspects the client is acting strangely, maybe showing signs of cognitive decline, or if they suspect that the client is being bullied by that new friend into withdrawing money, the advisor can call the TCP.
Wow.
They can pick up the phone and say, hey, I'm worried about your dad. He's acting really out of character. He's trying to wire $50,000 to an account in the Cayman Islands.
Ah, I see. So it provides a safety release valve. It allows the advisor to sound the alarm to someone who cares, but without giving away any control of the actual asset.
Exactly. And the source notes that while the TCP is often a family member, like a son or daughter, it ideally shouldn't be the same person as the power of attorney or someone who has a direct financial interest.
Why is that?
You want checks and balances. What if the person holding the power of attorney is the one stealing the money? It happens. You need a TCP to call who isn't involved in the transaction, who can be an objective third party.
Now, let's say the alarm bells are ringing loud and clear. The advisor thinks, my client, Catherine, is being scammed. Or Joe clearly doesn't understand what he's doing anymore. I think he has dementia. Can the advisor actually stop the money from leaving the account? Can they just say no?
Yes. This is the temporary hold. It is a relatively new and extremely powerful tool. Firms can pause withdrawals or trades if they have a reasonable belief that there is financial exploitation or a lack of mental capacity on the part of the client.
But it's not just a matter of freeze the account and walk away, I assume.
No, not at all. It's a rigorous process with a lot of oversight. The hold has to be transaction specific, if possible. You don't necessarily freeze the whole account, just the suspicious withdrawal. You absolutely must notify the client and provide your reasons, which you can imagine that conversation. Hi, I'm not letting you take your money because I think you're being scammed. That is a difficult, often hostile conversation.
And here's where it gets really, really interesting for the financial firm. The source mentions a no safe harbor risk for Canadian firms. This detail just blew my mind.
It is such a critical detail, and it shows the stakes involved. In the U.S., regulators often provide a safe harbor, which basically means if a firm acts in good faith to protect a senior and freezes an account, they can't be sued for damages if they turn out to be wrong.
Right, it's a we thought we were helping defense.
Exactly. But in Canada, the source explicitly says there is no such statutory safe harbor protection in many jurisdictions yet.
So play that out for me. I'm an advisor. I think my client is making a terrible mistake due to cognitive decline. They placed a temporary hold on the trade. But it turns out I was wrong. The client was actually fine. And because I froze the trade, they missed out on a huge market gain.
You could be liable for that loss. The firm could be sued for the amount of the missed gain. This forces firms to balance this intense moral obligation to protect the client against the very real legal risk of litigation. It means if a firm places a hold, they are really, really putting their neck on the line. It's a brave move.
Wow.
It just underscores how serious the red flags must be before they are willing to pull that trigger.
That is a fascinating tension. It really shows the complexity of this dealing representative role. You're part psychiatrist, part lawyer, and part bodyguard all wrapped into one.
And part economist,
Yeah.
which brings us to the environment these decisions all happen in.
Right. You could have the perfect suitability analysis, a watertight SIP, and a TCP on file for your client. But if the entire economy crashes, the best laid plans are still going to take a major hit. Let's pivot to part 4, the environment. The source gives us a crash course in economics. And honestly, my eyes usually glaze over when people start talking about GDP, but the source makes some distinctions here that are vital for any investor to understand.
It does, and it starts with the big number everyone quotes, GDP, gross domestic product.
The scorecard for the country's economy.
Essentially, yes. It's the total market value of all the goods and services produced in a country in a given period, but the source makes a vital distinction between nominal GDP and real GDP. This is where politicians and headlines can trick you.
Explain that difference.
Okay, so nominal GDP is just the raw dollar amount. Let's say in year 1, Canada produces 100 apples and they sell for $1 each. Our GDP is $100.
Simple enough.
In year 2, we produce the exact same 100 apples, but because of inflation, they now sell for $1.10 each. So our nominal GDP is now $110.
So the politicians go on TV and they say, great news, GDP grew by 10%, the economy is booming.
Exactly. But did we actually produce more stuff? No. We still just have 100 apples. Our standard of living hasn't improved one bit. Things just got more expensive. That's why real GDP is the truth teller. It adjusts for inflation to see if we are actually producing more value.
And for an investor, why does this matter so much?
It's all about correlation. Generally, when real GDP is going up, it means companies are selling more stuff, which means corporate profits are up, which usually means stock prices are up. When real GDP is contracting, profits fall, and stocks tend to fall with them. It helps the advisor set realistic expectations for returns.
Speaking of paying more for the same apples, let's talk about inflation, the silent killer of wealth. The source uses a great example here that I love, Caitlin versus Terrence. These little stories make the abstract math feel so real.
It illustrates the concept perfectly. So Terrence is the lender. He represents the saver. He lends Caitlin $100 at 2% interest. He's being responsible. He expects to make a small profit. But in that year, inflation unexpectedly spikes to 5%.
So walk us through the ending. On paper, Terrence gets his $100 back plus $2 in interest. He has $102 in his bank account.
Right. He looks at his bank account, sees the number is bigger, and he thinks, I made money. But because inflation is 5%, the cost of living has gone up. To buy the exact same basket of goods that used to cost him $100 groceries, gas, a haircut, he now needs $105.
So he has $102 in cash,
Yeah.
but he needs $105 to have the same lifestyle.
Precisely. In real purchasing power terms, he has lost $3. He actually lost wealth by lending his money out and being responsible.
That is just terrifying when you think about it. And Caitlin, the borrower.
Caitlin wins. She borrowed money to buy something, maybe a tool or supplies for her business. She gets to pay back the loan with dollars that are worth less than the ones she originally borrowed. The source calls this the distributive effect of inflation. Unanticipated inflation redistributes wealth from lenders, who are the savers, to borrowers, who are the debtors.
That is such a powerful insight. It explains why people with huge mortgages sometimes secretly don't mind a bit of inflation, as long as their wages keep up with it. Their debt stays fixed, but the money they use to pay it back with is worth less over time.
Exactly. It's like Robin Hood in reverse, or maybe sideways. But for the retiree living on fixed income bonds like our friend, Terrence, inflation is absolutely devastating. It eats their purchasing power alive. This is why advisors need to factor a realistic inflation number into those retirement projections we talked about earlier.
Now, connected to all of this is the business cycle. Expansion, peak, contraction, trough. And the definition of a recession. We hear that word thrown around constantly. Are we in a recession? The source gives a very technical definition.
Yes. It's not just a feeling. The standard technical definition is at least 2 consecutive quarters, so 6 months of declining real GDP. And this whole cycle is managed, or at least influenced, by 2 giant levers: fiscal policy and monetary policy.
I always get these mixed up. Let's clarify them once and for all for everyone listening.
Okay, the easy way to remember it is fiscal policy is the government's checkbook. It's all about taxes and spending. If the government wants to expand the economy, they can lower taxes, so you have more money in your pocket to spend.
Wow.
Or they can spend more money themselves, building roads, hospitals, sending out checks. This pumps cash directly into the system.
And monetary policy.
That's the Bank of Canada. They manage the money supply, and their primary tool is interest rates.
So when we hear on the news, the Bank of Canada raised rates today by 1/4 point, that's monetary policy in action.
Correct. And here's the mechanism. If the economy is overheating, if inflation is high, like in our Terrence and Caitlin example, the bank raises interest rates. This makes borrowing more expensive. Mortgages go up. Business loans go up. So people stop buying houses. Businesses stop building new factories. It cools the economy down.
And if we're in a recession?
They do the opposite. They lower rates. They make money cheap. They want to encourage borrowing and spending to jumpstart the machine again. It's this constant, delicate balancing act.
It's like driving a car with one foot on the gas and one foot on the brake at the same time.
And trying to read a map that is constantly changing while you do it.
So that's the weather. Now let's look at the machinery itself. Part 5. Financial markets. The source breaks this down into the most fundamental concept, supply and demand. Now, we all took Econ 101, we know about widgets. But the source uses a simple calculator example to explain how this sets the price for anything, including money.
It's great because it strips away all the complexity. Imagine a market for calculators. If sellers can sell them for $60, they will happily make 120 of them. They want to sell high.
Of course.
But at $60, buyers only want to buy a few. If the price drops to $10, suddenly buyers want 100 of them. But now the sellers only want to make 20 because there's no profit in it.
So the equilibrium price is where those two lines cross on the graph. Maybe at 60 calculators get sold at $30.
Exactly. And the financial market is just that. But instead of trading calculators, we're trading capital. We're trading money.
So who are the suppliers? Who is selling the money?
You are. I am. It's household savings. When you put money in a savings account or a GIC or a pension, you are supplying capital to the system. Also, corporations with retained earnings and governments when they run a surplus.
And the demand side. Who wants to buy the money?
Governments borrowing to build bridges, corporations borrowing to build factories, and of course, households borrowing to buy homes or cars.
So the interest rate isn't just some random number the bank makes up. It's basically the price of that money. And it's determined by where the supply of savings meets the demand for loans.
Precisely. If everyone suddenly stops saving, the supply of capital drops and the price of money, the interest rate goes up. If everyone wants to borrow at once, demand rises and rates go up. It's a market, just like any other.
The source also lists 3 personality traits of capital, which I thought was a cool way to frame it. Scarcity, sensitivity, and mobility. Mobility is the one that scares me a little bit.
It should. Money moves instantly. Trillions of dollars are traded every single day in foreign exchange markets. If a country makes a bad policy decision, say they threaten to seize assets or they start printing too much money, capital does not wait around to see what happens.
It gets out of there.
It flees. It moves to a safer country in milliseconds.
Like a flock of birds being scared by a loud noise.
Exactly. And that capital flight can crash an economy overnight. That's the sensitivity part. Capital is cowardly. It hates risk and uncertainty.
We also need to distinguish between the money market and the capital market.
It's mostly a time distinction. Money market is for short-term borrowing and lending, under a year, usually. Think treasury bills, commercial paper. It's where you park cash that you need relatively soon. The capital market is for long-term investing, stocks and bonds. This is where real wealth is built over decades.
And the distinction between primary and secondary markets. I like the new car versus used car analogy we discussed when we were prepping for this.
It fits perfectly. The primary market is like the dealership selling a brand new car. It's an IPO, an initial public offering. The company issues brand new shares. When you buy them, the money goes directly to the company. They use it to grow, build factories, hire people.
And the secondary market?
That's the used car lot. That's the TSX or the New York Stock Exchange. That's just investors trading used shares with each other. If I buy a share of Apple from you on the stock exchange, Apple doesn't get a penny of that money. You do.
Right. The company doesn't care about the daily stock price for its own cash flow, only for its overall valuation and reputation.
Exactly.
One last technical distinction in this section that I think is crucial because people get the terminology wrong all the time. Dealer versus broker. We use these terms interchangeably, but they are very different.
They are very different, and it all comes down to risk. A dealer acts as a principal. That means they own the stock they're selling. If a dealer does what's called a bought deal, they buy the whole block of new shares from a company, say 10 million shares, and then they try to resell them to the public.
So they bought the inventory. They're on the hook.
Yes, they are taking the risk. If the price drops before they can sell all the shares, the dealer loses money. They have skin in the game.
And a broker.
A broker is just an agent. They're a matchmaker. They connect a buyer and a seller, and they take a commission for the service. It's what's called a best effort underwriting. If the shares don't sell, the broker doesn't lose their shirt. They just don't make a commission. No risk.
Got it. So dealers have skin in the game, brokers just facilitate the game.
A simple but very accurate way to put it.
Okay, we're in the home stretch now. We've built the foundation with suitability. We've got the blueprint with SIP. We've checked on the occupants with the vulnerable clients rules. And we understand the weather from the economy and the machinery of the markets. Now, let's look at the actual vehicles people use. Mutual funds.
The bread and butter of the retail investor, for sure.
The source defines a mutual fund simply as a collection of holdings, but it categorizes them by three main objectives. And I think this circles back perfectly to our know your client discussion at the very beginning.
It absolutely does. The three objectives are safety of principal, income, and growth. And the most important lesson here is you can almost never have all three at once. You have to pick your priority.
Let's walk through the examples from the source because they show how these objectives dictate your behavior as an investor. First, we have Bob.
Bob represents safety of principal. The source says he needs to buy a home in 1 year. He has $50,000 saved up for the down payment. He absolutely cannot afford to lose a dime of that. If that $50K turns into $40, he can't buy the house. The dream is over.
So what does he buy? What kind of fund?
He has to prioritize safety over any kind of return. He puts it in a money market fund or a very short-term bond fund. He might make very little in returns, maybe just enough to keep pace with inflation if he's lucky. But he will sleep at night knowing his $50,000 will be there in 12 months.
Then we have Jane, our retiree.
Jane represents the income objective. She invests $35,000. She needs a regular monthly check from this investment to help pay her bills. The source notes that her account value might fluctuate a bit. It might drop to $34,800, then rise to $35,040. But as long as that cash flow, that monthly check, continues, the objective is being met. She is accepting some level of price volatility for the sake of getting that reliable income.
And finally, Stan. Stan is the guy who usually gets into trouble if he doesn't truly understand himself and his objective.
Stan is the growth investor. He has 30 years until he plans to retire. He buys an equity fund, a stock fund. He puts in $25,000. It goes up to $26,400. He's feeling great. Then some bad news hits the market, maybe a recession, and his fund drops to $24,000. He's actually lost money on paper.
But because his stated objective is growth, and his timeline is 30 years, that volatility is not only acceptable, it's expected.
It's the price of admission for higher potential returns. Growth implies volatility. If Stan panics and sells when it hits $24,000, he has turned a temporary paper loss into a permanent real loss. This is why the KYC process is so vital. If the advisor had wrongly identified Stan as a safety investor like Bob, Stan would never tolerate that drop. He'd sell, lose money, and probably sue. But because he knows he is a growth investor, he holds the course.
So let's bring this all back home. We started with the guy me walking into an office wanting to borrow a bunch of money for a hot tip on gold. We've traveled through the regulations, the economy, the markets, and the products.
And hopefully you can now see that the advisor saying no to that gold loan isn't being a killjoy or a roadblock. They are doing their job. They are applying the architecture of wealth.
It seems to me that the big takeaway here for anyone listening is that investing isn't just buy low and sell high. It's not about finding the next hot stock.
Not at all. It is a system. It's a system of suitability. Does this specific strategy fit my life right now? It's a system of protection, especially as we age, using tools like the TCP to build a safety net. And it's a system of context understanding that big forces like inflation and GDP affect us all, whether we pay attention or not.
My aha moment from this deep dive is really about self-knowledge. The most dangerous person in the market isn't the one who doesn't know the future. Because let's be honest, nobody knows the future. It's the one who doesn't know themselves. The one who doesn't know their own real risk tolerance or their own liquidity needs or their own time horizon.
I agree with that completely. All these rules, the KYC, the KYP, the SIP process, they are all designed to force that self-knowledge. They force you to look in the mirror before you look at the stock ticker.
So here's a final provocative thought to leave you with. We talked about how inflation hurts lenders like Terrence and helps borrowers like Caitlin. In a high inflation world like the one we've been living in, does that mean that being debt-free is actually a mathematical disadvantage? If your debt is being silently eroded by inflation, are you secretly winning?
That's a great question.
Or does the risk of leverage, as we saw with the tragic case of Catherine and the recklessness of Joe, does that psychological and financial risk always outweigh the cold, hard math?
That is the eternal struggle, isn't it? It's the battle between the efficient market hypothesis on paper and behavioral finance in real life. The math says one thing, the human ability to sleep at night often says another.
And I guess that is why we have dealing representatives to help us navigate that gap. Thanks for taking the deep dive with us today.
A pleasure. It was great.